Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. I've done a few videos on home ownership. Today what I thought I'd do is I'll dive into something a bit more niche, that is debt recycling. If you've never heard of debt recycling, the essence of it is that you are turning debt that is not deductible into deductible debt. And you can do this in a few different ways, which is what we'll be exploring further today. Before I get into debt recycling, we first need to understand the two terms I already mentioned, deductible debt and non-deductible debt. So what does that actually mean? The difference between these two types of debts is whether or not you can get a tax benefit from them. The type of debt itself is not important. It could be a credit card debt, line of credit, mortgage, car loan, etc. The debt itself is not the main contributing factor as to whether it's deductible or not. It's what you do with the debt that is important. A business might use a credit card to purchase stationery for the office last minute and incurs an interest expense on that. That could be deductible. A tradie might need a ute that's used exclusively for work purposes to go between sites, and they have a car loan. The interest incurred on that loan could possibly be deductible. Someone buying an investment property and needing a mortgage would be able to get a tax deduction for the interest incurred on that mortgage. They're all fairly standard deductions under Section 8-1 of the Income Tax Assessment Act 1997, and the basic examples, of deductible debts. A non-deductible debt could be any of the same debt types, but the difference is what it is used for. It's used for personal use rather than in the course of earning assessable income. Using a credit card to buy clothes or food is a personal expense, and so it's not deductible. Buying a car in general is a personal expense, unless it's a business asset. So a car loan, as a general rule, is not a deductible debt. Buying a home that you live in is also not a deductible debt. Okay, so I've given a few examples of deductible and non-deductible debt, but how does debt recycling work? How is it possible to turn a debt that's not deductible to something that is? The way you turn non-deductible debt into deductible debt is in the simplest form, changing the purpose of the loan from personal use to investment use. I'm going to go through a few examples. They'll all be using property as collateral, as that's the easiest way for most people to understand. I've got 5 scenarios that we can work through, and these will cover the main events, but there will obviously be other situations that I'm not illustrating today. Let's say you own one property and you live in it. You decide you want to buy an investment property. You can do this in a few different ways. In scenario 1, you have your home. Let's say it has a LVR of about 80%. Now, banks like to make sure that borrowers have at least 20% ownership in the home. That's so that if they do end up defaulting and they stop paying, as long as the market hasn't dropped a lot, the bank can recoup their funds. You can buy property with less, but that does incur LMI, and I'm not going to be going into that today. So you've got your home, 80% LVR, and you have an amount of cash. What are you going to do next? You can use that cash as a 20% deposit for that next property, and that next property is now an investment property. So you rent it out and it earns you an income. Pretty standard stuff, and obviously the loan would be a deductible debt. Next scenario is identical to scenario 1, except the new property is now going to be your principal place of residence, and you're turning the old property into an investment property. In this scenario, the new loan is not deductible, as it's been used to purchase a personal use asset. However, the old loan is now deductible because the nature of the debt has changed. The nature has changed from a personal use asset to an investment use asset. In scenario 3, we're going to change things up a little bit. Instead of having 80% LVR on the property, you've now paid down the debt a little bit and it's now down at 60%. You no longer have any cash for the deposit for the new property, but that's fine. The bank will let you use the existing property as collateral for the new one, and they'll let you borrow up to about 80%. So you have 20% that you can use to buy that next place. If property number 2 is an investment property, you can think about it in one of two ways. Either you've bought the second property at 100% LVR because you're borrowing 80% of the new property as collateral, and then the cash out that you've made is still debt, but that's paying the other 20% deposit required. Or you can think about it as though you have 2 properties, each with an 80% LVR. However, you have debt recycled part of that home, i.e. you've turned debt that wouldn't normally be deductible into deductible debt. In scenario 4, we have the exact same scenario, except instead of buying investment property, you now buy a new principal place of residence. In this case, essentially the home is 100% debt and the investment is 60%. You've now got 2 loans that are not deductible and 1 loan of 60% that is deductible. What you'll notice from these 2 scenarios here is that it doesn't matter what the collateral is for the loan. It doesn't matter if it's the home or the investment property that is the collateral. What matters is that the funds are being used for, whether it's for personal use or investment use. Example number 5 is probably what you'll see talked about most frequently online when it comes to debt recycling. And that is basically starting similar to scenario 1, where we have a property with 80% LVR, but that's not a deductible debt. We then also have some cash. What then happens is that they use the cash to pay down the loan, and then they redraw that out as a second loan, or they could have done a refinance with 2 splits. Either way works about the exact same. It's a lot easier to see if people actually split their loan with the bank into 2 separate loans, as it's a lot easier to visualize and keep track of what's deductible and what's not. It still works if it's kept as one, but you just need to make sure that you keep good records in case you ever get audited by the ATO. Okay, so they've split the loan into 2. They're using the home as collateral for both loans. 60% is not deductible, but that new amount they've invested in shares, this new loan is deductible. I put shares here, but it can basically be any asset that produces income. I plan to talk a bit in a future video, but with loans, generally there are 2 options. You can have either a redraw facility or an offset facility. Both work the exact same in reducing the interest on the loan. However, one is considered your money, the other the bank's. In order to make debt recycling work, you need to make sure the funds are put into redraw before you pull it out and split. Using money from an offset account does not constitute debt recycling and would not turn the debt from non-deductible into deductible debt. So make sure you keep that in mind if you ever want to use this strategy. Hopefully I've been able to help you better understand how debt recycling works, and I suppose the tax benefits around it too. If you have any more questions, please feel free to drop a comment below and I will answer if I can. Thank you so much for watching, and I'll see you guys on the next one.